Right now, 7 companies control nearly 1/3 of the entire US stock market. If you own an index fund, a 401k, or pretty much any retirement account, you're massively exposed to what I'm about to show you. And here's what nobody's talking about. This exact pattern has happened before. When it collapsed last time, investors lost everything, even though the companies themselves survived. 7 tech giants, Apple, Microsoft, Alphabet, Amazon, Nvidia, Meta, and Tesla, are now worth $14.2 trillion combined. That's nearly 1/3 of the entire S&P 500's value. Think about that for a second. 7 companies out of 500 control 32% of the index. Here's an even crazier stat. These 7 companies are worth more than the bottom 250 companies in the S&P 500 combined. Not by a little bit, they're worth 4.6 times more. When you invest in what you think is a diversified index fund, you're actually making a massive, concentrated bet on 7 stocks. This didn't happen overnight. In 2013, just over a decade ago, the top 7 companies made up only 13% of the market. By 2020, it was 23%. Today, it's over 32%, and it's accelerating every single quarter. The culprit? Passive investing. There's now $11 trillion in passive index funds and ETFs. When you put money into an S&P 500 fund, it automatically allocates based on company size. The larger the company, the more money it generates. As more money flows in, the stock price rises. As the price rises, the company gets bigger, so even more money flows in. It's a perfect feedback loop on the way up. But here's the terrifying part. The same mechanism that inflated these stocks to historic valuations will deflate them just as violently. These 7 companies trade at an average price-to-earnings ratio of 42. The historical average for market leaders? Around 22. To justify a PE of 42, you need extraordinary growth. We're talking 25% annual earnings growth for the next 5 years. But here's the problem. These companies aren't growing that fast anymore. They're mature, they're slowing down, and the math is about to catch up with reality. Apple is worth $3.5 trillion and trades at 33 times earnings. For a company that's barely growing, that's absurd. iPhone sales, which represent over half of Apple's revenue, peaked in 2021. They're not flat, they're actually declining. In a saturated global smartphone market where everyone already owns one and replacement cycles are stretching to 3 to 4 years, where's the growth supposed to come from? Apple's services business was supposed to be the savior, but that growth is decelerating too, from 18% in 2023 to a projected 8% in 2025. Meanwhile, Apple is losing ground in China, where local brands like Huawei are surging. For a company growing at maybe 5% annually, the fair PE ratio is around 18 to 20. If Apple's multiple compresses to just 18, the stock falls 45%. That's $1.6 trillion in market value vanishing from one company alone. Microsoft is worth $3.3 trillion with a PE of 38. Everyone's betting on AI and Azure cloud services to justify that valuation. But Azure's growth is rapidly decelerating. It grew 50% annually from 2020 to 2022, then 28% in 2023, then 16% in 2024. That's a clear trend. Microsoft doesn't actually break out AI revenue separately, so analysts are guessing. But when you look at the total revenue growth, just 15%, you have to ask, if AI is this revolutionary transformation, why isn't overall growth accelerating? If Microsoft compresses to a PE of 26, the stock drops 31%. That's $1 trillion gone. Nvidia is the poster child for extreme valuation. At $2.9 trillion with a PE of 58, it's priced for perpetual explosive growth that simply cannot continue. Yes, Nvidia's revenue has exploded, from $27 billion in 2022 to $113 billion in 2024. That's incredible, but it's not sustainable. AI infrastructure build-out is finite. Tech giants are spending about $200 billion per year building data centers and buying GPUs. But this is a one-time build-out, not recurring spending. US export restrictions have permanently eliminated 25% of Nvidia's market, and competition is exploding. AMD is gaining share. Google has its own TPU chips. Amazon has Trainium and Inferentia. Microsoft is designing custom silicon. Even at Intel's peak during the dot-com bubble, it only traded at a PE of 35. Nvidia, at 58, is pricing in a future that can't exist. If Nvidia's PE compresses to 22, which is normal for semiconductor companies, the stock crashes 62%. That's $1.8 trillion erased. Amazon's $2.2 trillion market cap trades at 41 times earnings. Investors value Amazon almost entirely on AWS cloud growth. But AWS growth is slowing for the same reason Azure is slowing. The cloud market is maturing. AWS grew 38% in 2021, then 29%, then 19%, then 13% in 2024. Every year, growth decelerates. Most companies that were going to move to the cloud have already moved. Meanwhile, Amazon's retail business faces serious structural problems. Labor costs are rising, warehouse turnover is 150% annually, and ultra-low-cost Chinese competitors like Temu and Shein are eating into Amazon's dominance. If Amazon compresses to a PE of 26, it drops 37%, losing $800 billion. Alphabet looks like the most reasonably valued at $2.1 trillion, with a PE of 28. But reasonable doesn't mean safe. Alphabet makes 80% of its revenue from advertising, and 58% of total revenue specifically from Google search ads. That business model is under existential threat from AI. When people ask ChatGPT, Claude, or Perplexity a question, they get a direct answer. They don't click through to websites, they don't see ads. Every query answered by AI is a query not going to Google. Google is trying to fight back by integrating AI into search, but this creates a paradox. If Google provides AI-generated answers directly in search results, users don't click through. Fewer clicks mean fewer ad impressions, less revenue. If investor concerns about search disruption intensify, Alphabet's PE could compress to 20. That's a 29% drop and $600 billion lost. Tesla is the most egregiously overvalued stock in the entire S&P 500. At $1.1 trillion with a PE of 73, it's trading at valuations that defy all logic. 73 times earnings for a car company growing at 3% annually. Every other automaker in the world trades at PE ratios of 5 to 8. Tesla trades at 73 because Wall Street values it as a tech company that will achieve full self-driving and deploy robotaxis. But full self-driving has been 2 years away for a decade. Meanwhile, Tesla's core business is deteriorating. Sales growth has collapsed from 87% in 2021 to just 3% projected for 2025. Competition is intensifying. Tesla has responded with aggressive price cuts, which are destroying margins. If Tesla is valued as what it actually is, a car company, it should trade at a PE of 12 to 15. At a PE of 12, Tesla stock crashes 84%. That's $920 billion erased. Now add it all up. Apple loses $1.6 trillion. Microsoft loses $1 trillion. Nvidia loses $1.8 trillion. Amazon loses $800 billion. Alphabet loses $600 billion. Meta loses $467 billion. Tesla loses $920 billion. Total destruction, $7.2 trillion. And that's assuming compression to PE ratios that are still above historical averages. If you think this can't happen, let me tell you about the Nifty 50. In the late 1960s and early 1970s, institutional investors concentrated their portfolios in 50 large-cap stocks. These were called one-decision stocks. You bought them and never sold because they were the best companies in America. The list included Coca-Cola, IBM, Xerox, Polaroid, McDonald's, and Disney. By 1972, these 50 stocks represented 38% of the total US stock market, even more concentrated than today's 32% in 7 stocks. And these stocks traded at an average PE of 41.9, while the broader market traded at 18.9. Investors justified extreme valuations by arguing these companies had permanently superior growth characteristics. Polaroid traded at a PE of 90, Xerox at 48, McDonald's at 86. Then, in 1973, the music stopped. The OPEC oil embargo hit. Inflation spiked to 11%. The Fed raised rates aggressively. The economy entered a severe recession. And the Nifty 50 collapsed. From December 1972 to September 1974, the Nifty 50 fell an average of 64%. Polaroid fell 91%. Avon fell 86%. Xerox fell 71%. Even the highest quality companies fell dramatically. Coca-Cola fell 64%. Disney fell 77%. IBM fell 48%. The valuations simply couldn't be sustained when growth slowed. Here's what investors today refuse to learn. These were great companies. Coca-Cola didn't go bankrupt. IBM didn't disappear. Disney survived and thrived. But their stock prices collapsed because the valuations were absurd. Coca-Cola eventually recovered and made new highs, but it took 15 years. Investors who bought at the 1972 peak didn't break even until 1987. The lower quality stocks never recovered. That's the same situation facing the Magnificent Seven today. The destruction won't happen in isolation. It will cascade through the entire market through a series of mechanical, automatic selling programs that feed on themselves. The Magnificent Seven start falling as earnings disappoint. Let's say they decline 15% initially. That directly reduces the S&P 500 by 4.8%. Investors see their accounts declining and start redeeming shares from index funds. When investors pull money out, the fund must sell holdings to raise cash. Because of market cap weighting, 32% of every dollar redeemed requires selling the Magnificent Seven. This forced selling has nothing to do with fundamentals. It's purely mechanical. The VIX, the market's fear gauge, spikes from below 15 to above 30. Rising volatility triggers automatic deleveraging by risk parity funds, which mechanically reduce equity exposure. Options market makers who sold call options must hedge by selling the underlying stocks as prices fall. Momentum strategies that were long the Magnificent Seven must sell when the trend breaks. All these mechanical selling programs activate simultaneously. The selling feeds on itself. This isn't a correction where rational investors buy the dip. This is a cascade where forced selling overwhelms any fundamental buying. Here's the timeline. In the first quarter of 2026, earnings season hits in mid-January. One by one, the growth deceleration becomes undeniable. Apple reports iPhone sales fell 3%, Microsoft reports Azure growth at 14%, Nvidia reports 38% growth, but disappointing guidance. By the end of Q1, the Magnificent Seven are down 14 to 22%. Financial media spins this as a healthy correction. They're wrong. In Q2 2026, April earnings confirm the problems are worsening. Wall Street's big banks can no longer maintain bullish stances. Goldman Sachs, Morgan Stanley, and JP Morgan all downgrade with slashed price targets. Redemptions from S&P 500 funds spike. $180 billion flows out in April and May. The cascade is in full force. By end of June, Apple is down 38%, Microsoft down 36%, Nvidia down 53%, Amazon down 41%. The S&P 500 is down 26% from peak. This is officially a crash. In Q3 2026, the selling is relentless. Margin calls hit leveraged investors. Retail investors who bought every dip finally capitulate. The Magnificent Seven reach their lows in late September. Combined market cap destruction, $7.1 trillion. The S&P 500 bottoms at 3,700, down 47% from peak. So who survives and who gets destroyed? The destroyed are those who believed passive investing eliminated risk. The retail investor who put his entire retirement account into an S&P 500 index fund watches it fall 45%. The pension fund holding 32% in the Magnificent Seven loses billions. The 401k holder automatically investing every paycheck watches decades of savings evaporate. Those who trusted financial media when they said, "You can't go wrong buying the best companies." Those who believed valuations don't matter. The survivors are those who understood concentration risk and diversified across asset classes. The survivor held 40% stocks, 30% bonds, 20% cash, 10% gold. When stocks crashed 46%, the total portfolio fell only 18%. The survivor recognized extreme valuations and took profits in late 2025, missing the last 5% of the rally, but avoiding the 62% crash. The survivors understood that passive investing during bubbles guarantees holding overvalued assets. This isn't about fear, it's about math. 7 companies representing $14.2 trillion, trading at an average PE of 42, requiring 25% annual growth to justify their valuations, but only achieving 12% growth and decelerating. When reality meets expectations, trillions in market cap evaporate. You have somewhere between 3 to 6 months to take action. Reduce exposure to the Magnificent Seven. Diversify across asset classes. Build cash reserves. Understand what you own. Don't try to time the exact top. Extreme concentration plus unsustainable valuations plus slowing growth equals violent correction. This happened with the Nifty 50 in 1972. It happened with the dot-com bubble in 2000. It's about to happen again. The only question is whether you'll be prepared when it hits, or whether you'll be another casualty of the greatest concentration of risk in market history. The math doesn't lie. The concentration is extreme. The valuations are unsustainable. The crash is coming. Will you be ready? Subscribe for more.